Hi, I'm Marna Ricker, EY America's Vice Chair of Tax, and today I'm going to give you all the latest information on the proposed reconciliation bill that the House Ways and Means Committee Chairman Richard Neal recently released. This is a $3.5 trillion bill, and it would enact much of President Biden's Build Back Better agenda, including expanding the social safety net, infrastructure financing, and addressing climate change. And as expected, it has many significant tax implications. The first thing to keep in mind is that this bill is not a final piece of legislation. Senate Democrats will also have a reconciliation proposal, and there will be significant differences between the versions that will need to be ironed out. That's why it is critical for tax leaders to understand the latest developments so you can be proactive as this legislation evolves. Based on the recent House Ways and Means proposal, there are three key potential impacts that tax leaders should be focused on: the rate increase, the potential impact on deals, and certainly your supply chain. First, there could be significant GAAP and cash effective tax rate increases. The biggest headline for companies is that the corporate tax rate is increasing 5.5% from 21 to 26.5% for large businesses. In addition, the draft proposal has several significant and complex changes to the U.S. international tax regime that will increase taxes paid by most, if not all, U.S. multinational companies. The draft also outlines several tax increases that would impact company owners who pay their business tax on their individual tax returns. And finally, there is also an increase in the top individual income tax rate, a capital gains tax rate increase, and a 3 percentage point surtax for top earners, and also changes to the estate tax. So pay attention there. Second, this legislation could result in increased deal pricing and costs for M&A. So now is the time to plan for a potential new environment. For example, depending on the effective date of the potential increases, higher corporate rates could mean considering cash-driven transactions in 2021 before the law would take effect, with an increase in tax-free transactions afterwards. It could also make tax-efficient global financing far more complex, so coordinate with Treasury. And third, there could be supply chain disruption and a need for operating model redesign. While supply chains certainly have been front and center throughout this pandemic, tax departments should take a very fresh look there. Companies should also actively review both U.S. proposals as well as global developments to understand the tax impact of where their location of assets should be, functions, and certainly risks. And on the global front, pay attention. Many countries are moving ahead with their own tax reforms. And don't forget that a group of about 140 countries are working within the OECD on proposals to change fundamental international tax rules and impose a global minimum tax of at least 15%. And as if that weren't enough, to add more complexity to the situation, tax departments should also be tracking the expiring provisions in the Tax Cuts and Jobs Act of 2017, or the TCJA. If Congress does not act on these provisions by the end of 2021, there's an automatic tax lift, and that will result in less interest expense deductions and require amortization of R&D cost over 5 to 15 years. The Neal bill would address the R&D issue, but it does not address interest deductibility. So, a lot for tax departments to be focusing on, but you don't want to wait until the passage of a bill before you start to develop your strategy. Right now, tax departments should be thinking about three things. So first, continue to monitor legislative developments. Understand how these proposed changes might impact your enterprise. Second, model and plan for these possible changes. At EY, we have seen that the companies who are out ahead, they're modeling prior to the passage, are the ones who are most able to move quickly when the legislation is signed into law. Whether it's modeling for a change in the tax rate or it's for your ongoing business initiatives, it's critical to have a plan. And third, today is the time to get engaged and to make sure your legislators understand your perspective. So there are sure to be a lot of changes coming up, so stay active and stay engaged. Thank you for your time, and we look forward to keeping you informed.